One question you got to know about universal life, you get how it works. When I pay my premium, what does the insurance company do with the premium after that? You want to learn universal life? This is one question you got to ask. Do you know what the insurance company do once you pay your premium? Cash value works the same thing as a traditional whole life. But when you pay your premium, what does the insurance company do with the money? The two things they do, right? I got a universal life policy. Let's say I paid $100 a month, got $100,000 of coverage. Part of the money go for the coverage, part of the money go into the cash value. Question. On universal life, I know part of my money is for the coverage, part of my money going to savings. But let me ask a question. Here's the question. Does the part of the money that's supposed to go into my savings, right? Do they put that money in first? Like if I paid $100, right? A percentage of my money go for the coverage, right? The rest of the money go into the savings account. Right. Does the money after the coverage money, does it go to my cash value first? They say, no. So see, what happens is, there's two things the insurance company does with the premium after you pay on a universal life policy. Number one, let's say for instance, let's say you pay $100 a month, right? This is the structure. I'm going to show you how it works. This is the structure of it. The first amount of money that comes out is called the cost of insurance, right? The cost of insurance. That's the first. That's not the premium, right? It's the cost of insurance, right? So they take a percentage out of that money, pay the cost of insurance, right? I'm going to deal with that. After they pay the cost of insurance, the second thing they pay is hidden fees and expenses, right? Which is some random shit. You go look at a universal life policy, them damn things got miscellaneous. You know when people put miscellaneous expense on stuff, that shit could be anything, right? They got all types of fees in there that don't even make no sense, but it's all built in there. So watch this. Let's say you spend $100, right? And let's say the cost of insurance was $25, right, a month, based on your age. I'm going to deal with that in a minute, but let's say it was $25. Let's say the hidden fees and expenses was $5, right? So I paid $100 in premium. They took $25 out to pay the cost of insurance, $5 to cover the cost of hidden fees and expenses. The company came up with the rest of the money, which in this case is $70, goes into your cash value to start billing it, right? In the beginning, it's all good, right? Because here's why it's all good. Because see, when you pay your $100 in premium, right? This you got to realize about universal life. The cost of insurance is actually annual renewable term. Say annual renewable term. Yeah. Meaning, think about annual renewable term. So when you get it, the misguided part is the premium is actually cheaper than traditional whole life. That's why it goes by people's head, right? Because the reason why they can charge you cheaper is because the cost of insurance, it was the annual renewable term part, is cheaper in the beginning, right? Because you're younger. But what happens is, because it's annual renewable term, the cost of insurance keeps increasing on you every year. You say, why, Coach? Because every year you get older. Every year you get older. And as I get older, I'm 1 year closer to my life expectancy. Right? So yeah, you got that thing in your 20s. Oh yeah, it's cheap because your cost of insurance is low. You so far away from life expectancy, is crazy. So the cost of insurance is cheap. So when you send your $100, not that much money is coming out of your $100 premium for cost of insurance. Not that much money is coming out for your hidden fees and expenses, right? So you thinking you good. Cash value, billing, you rolling. Getting some interest, you rolling. But here's what happens. But let's say 10 years later, 15 years later, well, guess what? That cost of insurance part, that was, in this example, was $25 when you bought it. Now that shit, $90. Wait, what? Yeah, because every year you're getting older, right? But you don't see this. But this is what's happening in the past. So now, when you send your $100 a month to the insurance company, $90 is coming out to cover the cost of insurance because you're 10, 15 years older. Now the hidden expenses have increased. Just cost of doing business, baby. It's the cost of doing business, right? Everything increases. So now when you spend $5 on hidden fees and expenses, man, now you're spending $10, $15. Let's say you spend $10, right? So damn, wait, I spent $100 in premium. They took $90 out for the cost of insurance. They took $10 out for the hidden fees and expenses. Well, how much money going to cash value now? You say, wait, what? Yeah, you send them $100 a month. $90 comes out for the cost of insurance. $10 comes out for the hidden fees and expenses. Well, how much money going to the cash value now? Nothing. 90 10 is 100. So what happens is, at this point, I'm teaching you something. At this point, let's say fast forward 10 years later, you 20 years in. Now the cost of insurance, let's say in this example, is $125. You say, wait, what? Yeah, you 20 years older than what you originally got it. I say, hold up. But the premium stays the same. Right, but watch this. So let's say you paying $100, But now the insurance company takes to pay the cost of insurance, but now the cost of insurance is $125 a month. So think about that. If you send them $100, the cost of insurance is $125, and let's say the hidden fees and expenses is another $25. That's $150. Do you realize if the insurance company got $150 of cost and expenses, and you only sent them $100, you do realize you short. You send them $100, but between the cost of insurance and hidden fees and expenses, your $100 is insufficient. What do you mean, Twine? That $100 is not sufficient amount of money to cover cost of insurance and the hidden fees and expenses. So now you say, where y'all gonna get the extra $50 from? Right? Since my premium is short, it ain't gonna work no more. Where do you get the extra money from? So where you get the extra money from? Guess what they start doing? They start pulling from your cash value, AKA your savings. And they start pulling from your savings to cover the cost of insurance and the hidden fees and expenses. And they will continue to pull, as it increases, they will continue to pull from your cash value to cover them expenses. And they're going to continue to pull from that cash value until there's no more money left in the cash value. And when there's no more money left in your cash value, guess what happens? When there's no more money from the cash value, ain't no more money to use, then guess what happened to the policy? You still paying the premium though. Guess what happened to the policy? That shit laughs on you. That shit laughs. Say, wait a minute, man. How in the world can I be paying premium and my policy lapse? That don't even make sense. The only time a policy is supposed to lapse is if you stop paying premium, right? If you stop paying premium, you cancel, then the policy lapse. How can this thing be set up to where I continue to pay my premium and this shit just automatically gonna last even though I'm paying my premium? Yeah, even though you're paying your premium. Wait, hold up. What happened to all the cash? See, at a certain point, they start using your cash, right, to go cover the cost of insurance and the hidden fees and expenses. And a point, your shit laughs on you. I'm going to show you what's crazy. In a lot of universal life policies, I saw seeing recently, right? They don't even send people to cash value no more. That's crazy. A lot of companies that do universal life don't even send people to cash value. They just send them the policy with all the words and shit. No, you got to ask them people for the cash value chart because it'll show it to them in there. It'll literally show it to them how it works in there. And I'm saying to myself, if I never touch this money, how I end up with no money? That's a question. If I never touch this money, how do I end up with no money? That's a good question to ask a universal life person. If I never touch the money, how I end up with no money? At some point. That don't make no sense. But that's how it works. When the cost of insurance and the hidden expenses get to a point where my premium is insufficient, I'm saying that to say, in certain universal life policies back in the day, it used to say in the paperwork, your premium will become insufficient in this shit. It used to say it in words. Now then it got more sophisticated and they hid the words or whatever the case may be, but the words used to be literally in the policy. Like if somebody got a universal life policy and they got the cash value, what you'll see, it'll start at 0 in the first year, maybe 2, then you see the cash value bill, then you're going to see the cash value bill to a point. And then after that point, it's going to start decreasing all the way down to 0. Then at the bottom of the years, you're going to see stars. The death benefit is going to be stars, and the cash value going to be stars. Say, damn, if life happened to me in this year, will we get stars? Yeah, you get 2 stars. That's what I used to do people, right? Say, yeah, look about this. Yeah, life happened. Guess what? You get 2 stars. 3 stars. Look at it. Sure, you get stars. Look, if life happened right here, you get 3 stars. Ain't that something? You get 3 stars. I ain't no money. Now you get 3 stars right there. Let's tell you, look, there's no death benefit. It's got stars right there. They got the asterisks. They got stars right there. And then the cash value, there's stars. That's what I'm saying. Y'all be talking about this borrowing shit is crazy, right? I'm about to deal with that in a minute. I promise I'm going to deal with that because I'm about to go to index universal life, right? But you got to know universal life because all index universal life is universal life with a little index part, right? They got a different investment strategy to it. It's the same heart of it, though. But universal life has the same heart as a traditional whole life policy. It's all connected. It just got little variations to it. But that's universal life. And I'm saying to myself, if that's the case, I'm trying to figure out how does that benefit me? How does that benefit me? How is that in my best interest? And when you do the math of it, it's not. But I'm just teaching how it works.